Yeah, sure. It's great. It's great to see you this morning.
Good, good. I want to talk to you first up about IPOs. I know that you have the direct listing that's there with Warby Parker today, but just IPOs in general, it's been an incredibly hot year. I was looking at the numbers. I think it's $105 billion that we've already seen this year, just through Monday of this week. And that really kind of challenges the highs that were set back in the tech boom and tech bubble for those things, way more than we saw last year. We did see a little bit of volatility picking up. All of this has happened under this historically low volatility. Now we're seeing a little more, and I just wonder what that means for the pipeline. Does that make people think, okay, we better put a pause on things, or do they think we better hurry up and get more down the pipeline before things get worse?
We're mixed results. I would say a little bit of both. Last year was obviously a blockbuster year for IPOs. We saw a record number of IPOs come to market, and this year we've already surpassed that. What we are starting to see is investors are becoming a bit more discerning, and companies are making decisions based on what they think the market conditions will be for them. So some companies are pushing off their timeline by a few months. Others are still coming to market right now, and many being very, very well received by investors. So when they have a good story to tell, it's still a company that investors want to be part of for the long term. We're seeing a lot of those companies come to market and do really well.
You are wearing glasses today. I don't recall you generally wearing glasses. Is that in honor of this direct listing?
So I wear glasses. I also wear contacts, and I felt like today I'm going to put on one of my pairs of Warby Parkers. I've been wearing them for years, and it's fun to see them becoming part of the NYSE community today.
Direct listing. Why don't you explain to people direct listing, how it's different, and why companies, not just Warby Parker, you've also had ZipRecruiter, Spotify, Roblox, a lot of other companies this year that have chosen the route of direct listing. What is that and why?
Yeah, so it's so interesting when you think about how this came to be. It's been 5 years since we first started talking to Spotify about the idea of decoupling capital raising from going public. So they wanted to be a public company, but their goal wasn't to raise money. So they came to us and said, is there a way we can have the exchange actually price the opening trade of our company and value the company and see its market cap from that, not from an IPO the night before? And there were really two drivers. One, cost of capital. So if you see an IPO pop 100% the next day, looks like a great IPO, not so much if you were the one that sold it the night before. So that cost of capital is really a driver for many companies. Second, democratization of access. So when you think about an IPO in the traditional sense, when shares are being sold by the company to investors the night before, and it's a subset of investors, there's artificial constraints on both the supply side and the demand side. With a direct listing, you remove those constraints. You don't have lockups. You don't have constrained allocations, and you let the market actually set the price for the company as it goes public. And all investors are on a level playing field during that moment in time. And so retail investors and others can participate on that first trade. And so we started to see some companies picking up steam. We saw Spotify was the first, Slack was the second a year later. And now we're Warby Parker is the 8th direct listing we've had here on the NYSE. And there are companies looking for choices now as to how they go public. We've obviously talked a lot about SPACs, but there are more choices that a company has on their path to the public markets than ever before. And it's giving them a lot of opportunity to think about their reasons for going public and what's the right mechanism for them.
That sounds pretty good the way you just laid it out, but does that make me think that companies that take the traditional IPO rate, a way of going back out about things, are having a problem with these things, or are retail investors suckers if they buy those IPOs? You think of companies like an Uber or something where there's a big drop, or another company where there's a big pop at the opening.
Well, retail investors are typically not a significant part of the allocation in the IPO offering the night before their first day of trading. And so they're missing out on some of that benefit. But if you're thinking about the long-term investment in a company, certainly day one isn't reflective of where it's going to be over the coming years. And retail investors often have a long time horizon, but it gives them that access at that first moment in time. There's still great reasons to do a traditional IPO, and we see many companies choose that path when they want to select their investor base and really have a more curated target investor base to start, in the hopes that those will be their long-term investors. It doesn't always work out that way, but that's what they're going for. The fact is, they just have choices, and they can think about what makes sense for them. And having more control over their cost of capital and really decoupling that capital raise from when they go public is the goal of the direct listing. We did file with the SEC and received approval at the end of the year, so they can actually also have capital raise as part of that.